What if the biggest secret to becoming a millionaire isn't finding the next explosive stock, but simply knowing where to put your money once you have it? Because when most people receive extra money, they think about what they can buy: a bigger house, a better car, a more expensive lifestyle. But wealthy people often think about something completely different. What can this money own? A business, a portfolio of stocks, real estate, bonds, private investments, or assets that can produce cash flow for years. And here's what makes this interesting: a millionaire doesn't necessarily invest like someone with $1,000. Because once your wealth grows, the objective changes. At first, you're trying to build wealth. Later, you're trying to protect it, grow it, and make it work efficiently. So today, we're breaking down how millionaires actually invest their money, where their wealth can be allocated, and why simply copying a millionaire's portfolio may not be the right strategy for you. One of the most common places wealthy investors put their money is the stock market. But there's an important misconception. When you hear millionaire investor, you might imagine someone sitting in front of six monitors buying and selling stocks every few minutes. That's not necessarily how long term wealth is built. Many investors use diversified portfolios that include broad market index funds and other publicly traded investments. The basic idea is simple. Instead of trying to predict which single company will dominate the next decade, you can own a diversified collection of businesses. If those businesses grow and become more valuable, investors can potentially benefit from that growth. And some companies also distribute profits to shareholders through dividends. Here's where compounding becomes powerful. Imagine someone has $1 million invested. A hypothetical 7% return would represent $70,000 of growth in a year. A hypothetical 10% return would represent $100,000. But these are illustrations, not guarantees. Markets don't deliver a fixed return every year. Some years can produce strong gains, others can produce significant losses. That's why wealthy investors often care less about hitting a home run every year, and more about staying invested and managing risk over long periods. The second major asset is real estate. Real estate has been a major component of wealth building for generations. Why? Because certain properties can potentially provide multiple sources of return. First, there can be rental income. Second, the property may appreciate over time. And third, depending on the financing structure, tenants' rent may help cover some of the property's expenses and debt service. Imagine an investor owns a rental property. The property produces rent. That rent pays operating costs. Some may go toward financing, and whatever remains can potentially become cash flow. Meanwhile, the property itself may change in value, but real estate has risks. Vacancies happen. Properties need repairs. Property taxes and insurance can increase. Interest rates can change, and property values can fall. So, wealthy investors aren't simply buying houses because they're wealthy. They're analyzing the numbers, cash flow, location, financing, taxes, and risks. Here's where millionaire investing gets particularly interesting. Some wealthy people don't just invest in companies, they own companies. A business can potentially produce income and increase in value. Think about a successful company. It has customers, employees, products, intellectual property, brand value, cash flow. If the business becomes more profitable and valuable, the owner's stake could potentially become significantly more valuable. This is one reason entrepreneurship has created enormous fortunes. But business ownership comes with enormous risk too. A business can fail. Revenue can disappear. Competitors can take market share. And unlike buying a diversified index fund, owning one business can concentrate your risk heavily. That's why the phrase invest in yourself can be powerful, but it shouldn't be confused with guaranteed success. A business is an investment, and every investment has risk. Now let's talk about an asset class that isn't nearly as exciting as stocks or startups. Bonds. But boring can be useful. Bonds can provide investors with interest payments under their terms, assuming the issuer meets its obligations. Wealthy investors may use bonds and other fixed income investments for several reasons: income, diversification, liquidity, and potentially reducing the overall risk of a portfolio. Think of an investor with millions of dollars. They don't necessarily need to put every dollar into the highest risk opportunity available. At a certain point, preserving wealth becomes just as important as creating it. A millionaire who loses 50% of their portfolio doesn't just need to make back the money, they need to recover from a massive setback. So some investors choose to balance higher growth assets with investments designed to provide stability or income. What if you like real estate, but don't want to deal with tenants, repairs, or property management? That's where REITs, or real estate investment trusts, can come into the picture. REITs allow investors to gain exposure to portfolios of income-producing real estate without directly purchasing an entire property. There are REITs focused on apartments, warehouses, healthcare facilities, data centers, retail properties, and other sectors. Investors can potentially benefit from rental income generated by the underlying properties through distributions. But again, there's risk. Publicly traded REIT prices can fluctuate. Interest rates matter. Property markets can weaken, and distributions aren't guaranteed. The bigger lesson is that wealthy investors often think beyond a single asset. They're thinking about exposure to entire categories of assets. As someone's wealth grows, they may gain access to investment opportunities that aren't available or suitable for everyone. These can include private companies, private equity, venture capital, private credit, and other alternative investments. Imagine investing in a private company before it becomes a major corporation. If the company succeeds dramatically, the investment could potentially become extremely valuable. But here's the other side. Many private investments are highly risky and can be difficult to sell quickly. Some investments can lose most or all of their value, so this isn't millionaires have a secret investment that makes guaranteed money. It's the opposite. Wealth can give investors more opportunities, but it doesn't remove risk. In fact, wealthy investors often have to think carefully about liquidity, diversification, due diligence, and concentration risk. Here's something people often forget. Millionaires don't necessarily invest every dollar they own. They may keep some money in cash or cash-like investments. Why? Because opportunities appear. Markets fall. Businesses need capital. Unexpected expenses happen. And sometimes the best investment is simply having enough liquidity to avoid being forced into a bad decision. Imagine an investor has all of their money locked inside long-term investments. Then an emergency happens. They might have to sell at an inconvenient time. Liquidity gives you flexibility, and wealthy people often value flexibility enormously. Because when you have capital available, you can act when opportunities appear. But there's one investment that often gets overlooked: human capital, your knowledge, your skills, your ability to earn. Consider two people. One has $10,000 invested but earns $35,000 a year. Another has $10,000 invested but earns $150,000 a year. The second person's ability to generate additional capital is dramatically different. That's why early in your wealth journey, increasing your income can be extremely powerful. Learn a valuable skill. Build a business. Become better at your profession. Improve your sales ability. Learn technology. Develop expertise. Because the more you can earn, the more capital you can potentially invest. And then that capital can begin working alongside your labor. That's how the wealth building cycle starts accelerating. So, what do all these investments have in common? The millionaire mindset isn't necessarily, how can I make the most money as quickly as possible? It's often closer to, how can I allocate capital intelligently? Instead of spending every extra dollar, or they may buy assets. Instead of chasing every trend, they may focus on businesses and investments they understand. Instead of taking maximum risk, They may think about protecting what they've already built, and instead of depending entirely on one source of income, they may build multiple sources of wealth. But here's the most important part. You don't need $1 million to start thinking this way. You can start with $100 or $500 or whatever amount your financial situation realistically allows. The amount matters, but the habit of turning earned income into productive assets is even more important. So, where do millionaires actually invest their money? There isn't one universal millionaire portfolio, but many wealthy investors may have exposure to combinations of stocks and index funds, real estate, businesses, bonds and fixed income, REITs, private investments, and cash or liquid assets. The exact allocation depends on the person's age, goals, income, taxes, risk tolerance, time horizon, and financial situation. And that's the real lesson. Wealth isn't simply about finding the perfect investment. It's about learning how to allocate capital, earn money, keep a portion, turn some of it into productive assets. Allow those assets time to grow, manage risk, and repeat. Because eventually you want to reach a point where you're not only working for your money is working alongside you. This is capital theory. If you want to understand how wealthy people think about money, investing, business, and wealth creation, subscribe. Because building wealth starts with learning how to make your money work.